Hey everyone, welcome back to Investment Physics. Today I'd like to analyze a stock that some of my friends were asking about, Rivian, because it has got some traction in the news for some reasons I will go into later. Disclaimer, I'm not a financial advisor. Please do your due diligence before taking my opinion seriously. The methods I am going to show in this video are written in the book called Intelligent Investor by Benjamin Graham. Um, the fundamental analysis principles are from that book, and some others are from reading articles here and there, and some from my own experience even. Um, Let me first tell you what Rivian as a company does. So they basically manufacture electric vehicles. The most popular EV manufacturer in the US today is Tesla. Of course, there are a lot of other people trying to get into the game, including manufacturers like BMW, Volkswagen, Ford, GM, etc. There were a couple of startups that IPO'd in 2020-2021 timeframe. One of them is Rivian, and then there was another company called Neo. There are a few of these cars running around still, but they are not as big as Tesla yet. So that makes an interesting question. What if this becomes tomorrow's Tesla? So should somebody buy the Rivian stock? And that's what I'll try to explain today. Um, Rivian was founded in 2009, but they were operating for almost more than 10 years before they went IPO. They went IPO in 2021. At that time, the interest rates were very low because the COVID had just ended and the Fed were trying to spruce up the economy. Because of that, a lot of startups IPO'd in that time frame, and then the stock price really blew through the roof immediately after the IPO. So in its peak in 2021, Rivian was priced at around 95 to $100. Today, it is $25. So that is definitely like a 75% drop. And then some of you might think, it was $100 once in the past and now it's 25. What if I buy a lot now? And what if it goes to $100 in the future? And that's when I'll try to explain what other things to consider before you buy a stock. Um, the most fundamental thing why a business exists is to make profit. So if a business is not profitable today, it should at least have a clear plan and vision in the future of when it intends to be profitable. If there is some startup or some CEO who claims that profitability is not important, we're all about growth, we just want to keep growing forever and doesn't give any clear timelines for profitability, then that is a clear red flag, and I would traditionally stay away from such a business. Let me show you how to identify profitability when it comes to stock. So there is a metric called as PE ratio. P stands for price and E stands for earnings. Um, so basically, if the PE ratio is positive, it means this company made a profit. If the PE ratio is negative or zero, it means it was in a loss. This is also used to identify which is a cheap stock. Basically, any stock that is below 20 PE is considered to be kind of a cheap stock, and if it is above 50 or something, then it is considered to be an overpriced stock. Of course, there are a lot of caveats to this. The numbers I gave are not like well-written rules; they are just basic guidelines. These numbers depends on the individual sector and the companies, and PE is of course not the only metric to consider. If that were true, then it would be very easy to pick stocks, right? You just have to go and Google the lowest PE stocks and just buy a bunch of them. But that is not true. But anyway, since I started with PE, let me show you what the numbers look for Rivian. Yeah, so this is a basic historical chart for the P/E ratio as well as the stock price. This shows data from 2022 to 2023, but because the company just IPO'd in November 2021, it's just 2 years of history, and that's not really a lot of history to see how the market has judged its performance. The number one basic rule when picking a stock is try to pick a company with a long history, at least 3 to 5 years, so that you have a clear idea of what the others think about this company, and the others would have already weighed this company to a certain extent. So you would already know what the fair price is for the company. In this case, it's a very young company, so we cannot really rely too much on historical data. But whatever data we have, we can see that the PE ratio is always zero or negative, which means that the company has not made a profit till date. This PE ratio is showing in the bottom, it's always a zero. This EPS stands for earnings per share, and it says here TTM net EPS. TTM stands for trailing 12 month, which basically means for the last 12 months, what was the earnings per share in this case. The higher the earnings per share, that is means it's basically a company that is doing well. The more negative or lower it is, it means it is a loss-making venture. In this case, you see that the earnings per share has been going more negative compared to the past, which means that it has been racking up on the losses a bit. There is another metric called as the forward PE. Um, Let me just zoom in on this so that you can see it better. Right. So the forward PE is basically a method of saying this is the price to earnings ratio today. What could be the price to earnings ratio tomorrow, like 1 year from now, 3 year from now, 5 years from now? If there is a higher price to earnings ratio in the future, it means that, and if the price to earnings ratio today is low, it means that there is a chance for the price of the stock to go up. So it is a very good idea to buy the stock now, because there is some methodology or model that justifies that there is a higher PE in the future. In the case of Rivian, at least till now, the PE ratio has been negative, and the forward PE also is showing to be more negative. So you can see that in December 2027, it's estimating it to be like minus 122x, and it's like on a steady decline from 2023 to 2027. So that means that this company is not expected to make a profit anytime till the end of 2027. And then you can see that in 2028, there is a slightly higher PE, which means that there is a chance that there is a profit by the end of 2028. But then again, it tapers off down like all the way till 2032. Like it's not a very high PE, it's still within like 10, and then it tapers down all the way to 1. So what this means is that at least for the next 5 years, there is no hope for this company to make a profit. After that, there is a slight chance to make a profit, but not too much. And those profits are not consistently going upwards, it's rather tapering downwards. Um, a disclaimer about forward PE, it is not a foolproof method. There are many models that estimate how to calculate forward PE. Some of the basic assumptions are you take the current sales, you calculate what is the growth revenue, you kind of put some model and you estimate the growth revenue for the sales could be so much in the future. And then you try to remove its taxes and operating costs and all those things, and then you try to get what could be the earnings per share, and then you try to estimate what it could be like 5 or 10 years in the future. Of course, like I said, there are a lot of moving parts to what I just described, and it is not easy for anybody to say like this is going to be it's not set in stone that this is going to be the exact forward P like 10 years from now. Like nobody could know the future. Like the company could go bankrupt, or they could make some $1 billion deal with somebody else, and everything could change overnight. But as of the data we have today, it seems like the company will not be profitable for the next 5 years. And even for the next 10 years, it's not going to be hugely profitable. It's going to just be barely profitable. Um, Let me go into the next thing. So this is basically, if you Google any stock and just put earnings, it basically gives what was the numbers looking for like the past year. I will not go into everything here. Let me just cover some major things. So you can see that there is something called as net income, and then there is a net profit margin. Um, a good company usually will have increasing net income over the quarter and over the years, and at least the same or an increase in profit margin. A profit margin, for a very fundamental understanding, is if you buy something at $10 and you try to sell it at $11, it means you made a $1 profit. In this case, your profit margin is 10%. The higher the profit margin, that means more likely that the company will do well, and it's usually a good principle to choose companies with a high profit margin that grows over the years or at least stays constant over the years. In the case of Rivian, let me start with 2022. So net income is minus 1.71 billion, and the profit margin is minus 470%. You see that now the profit margin is minus 320, minus 259, and then minus 204. So you can see that the profit margin is definitely decreasing, but it is still very much in the negative. It went all the way from minus 400% to something like minus 200%. And then same for the net income. The net income went from minus 1.7 billion to minus 1.35 billion. So basically, the net income is kind of reducing, and the net profit margin is also reducing. It is showing some signs of improvement, but not much that would get the interest of any value investor or somebody who buys stocks based on the fundamentals alone or based on how this business is performing. Um, Let me also talk about the market cap of Rivian. So market cap basically shows the valuation of a business. Rivian's current market cap based on its stock price is $23.4 billion. The largest EV manufacturer is Tesla, and the market cap of that is $855 billion. So Rivian is not even like 10% of Tesla's market cap. It's just to give you an idea that Rivian is a really small startup. So you have to think about it as a company that is just bootstrapping and starting to grow. And many of these metrics that I just described are expected to be negative for a startup. So it is hard to do a fundamental valuation for a startup, but I'm just showing you the method that is usually followed. Um, Let me now show you another key metric called as the price to sales ratio. Whenever a company is not profitable, but they are still selling goods, a key thing to consider is price to sales ratio. So it basically just is the ratio of the current stock price divided by the sales revenue. The lower the price to sales ratio, that means it is like good. Of course, it should not be negative, it should be a positive number. But the lower it is, it means that it's probably a good idea to buy the stock. In this case, the price to sales ratio of Rivian, it was very high in 2022 during the IPO time. It was around 32, and then it has come down to like 10.6, and it is hovering around the 10 range. Let me show you the price to sales ratio of Tesla to give you like a comparative analysis. So Tesla has a longer history and there has been a lot of ups and downs. So price to sales ratio, you can see that has been all the way high in the 23s, and in the lows it has been 2.6 whatever. But in the past few years, starting from 2020 to 2023, it was high at 22 and currently it is at 10-ish. So that means that the price to sales ratio is reasonable for a company like Rivian. It means that compared to the amount of sales revenue they are getting, the stock price is not too high. It's kind of okay. Um, Let me now show you the financials. So if you just go into Yahoo Finance, there is like a lot of info already in here in a nice table form. So just click on the financials here. Yeah, I just went to Yahoo Finance and typed in Rivian and then went to the financials tab here. This shows the data from 2019 to 2022. All this data is for the entire year. So basically, we do not have 2023 data because the year hasn't completed yet. This TTM means trailing 12 months, which means for the last 12 months, what the number was in this case. There are a lot of numbers here. I don't want to go into everything. But I just want to give you a gist of what it looks like. So you see a lot of negative numbers here, like in operating income, you see like these huge negative numbers. And then this one is called as net income for common stockholders. Again, you see a lot of negative numbers. This is the basic EPS and the diluted EPS. EPS stands for earnings per share. The higher this is, that means the better the stock is doing. So here again, you see that it's very much in the negative, and the negative value is kind of increasing, which means it's kind of doing worse, not getting better much. And then this is the total operating income. Operating income is basically after removing all kinds of expenses from your sales, what is the amount you have, and that is it started with minus 409, and right now it's a very high number compared to the starting value, which means that even the operating income is getting worse. The expenses are definitely increasing, and then yeah, I think even the normalized EBITDA is increasing. So EBITDA stands for earnings before interest, tax, depreciation, and amortization. Basically, you want this number to be positive, which means that the company is making a profit, and then the stock price will kind of go up, because if it's profitable, that's what happens to the stock price. I'm not trying to show you all these numbers and explain them each because of the time constraint. All I'm trying to say is there's a lot of negative numbers here, which just shows that this company is a startup. It is in growth mode. It is unproven, and they still have a lot to do before it can become profitable. So this kind of means that it's not a company that you would go all in and put in like all your life savings into it type of thing, because it's probable that they could go bankrupt or they could go big. Out of 100 startups, like only 2% of them succeed. So you should always like have your risk allocation in place based on this. Let me now, yeah, I already told you that. So now, by now, you know that all these numbers are negative and it doesn't look too good for Rivian. So does it mean that you never buy it? Well, let's not jump into a conclusion yet, because till now we were only looking at the fundamental analysis, and this works only for a company with a proven history and who have been in the business for a long time. But Rivian is kind of like a startup, so whatever methods I showed you till now are expected to look bad and to have a lot of negative numbers. Um, let's see if there are any other large mutual fund holders who are buying Rivian. So for this, I showed this tool in a previous video of mine, datanoma.com. I just put in Rivian and it basically shows what has been the activity in the last quarter. There are no big names here, like there is no Bill Gates Foundation or Berkshire or something like that. But you see like a couple of names repeating again and again over the quarters. And they have like, see this name like Viking Global Investors. They sold 100% of their stock in 2022 Q4, and they again bought some stocks in 2023. If you go and see the price in 2022 Q4, it was around $30. That's when they sold, because they probably thought $30 is like a high price for Rivian, and then they bought it again in 2023 at around $20. So it seems like, and if you also see the percentage of change to portfolio, it is all like it's not even coming to 1%. It's like 0.24, 0.38, etc. It basically means that none of the big mutual funds are trusting this company enough to put even 1% of their capital into the company. And the ones who are buying and selling, they are doing like very short-term trades. Like they are selling it when they see that it's profitable, and then they are buying it again when they see it is undervalued, and it's very range bound between $20 to $30 range. Let us look at if there are any other institutional holders given by our Yahoo Finance. So here again, I just go into this holders list in the Yahoo Finance and it shows a complete list. So it says that 68% of the institutions, 68% are held by institutions. And the biggest one is Tesla. I mean, sorry, it's Amazon, which is kind of interesting because nobody else is investing in such high amounts. But for some reason, like Amazon has put 17% of the holdings. So this is not 17% of Amazon's holding. It means that 17% of Rivian stock is held by Amazon. Um, Let me pause this video now because I've kind of already exceeded 20 minutes. I'll make a part two about the continuation. Thanks.